Welcome to the More Doors Podcast. I am Brian Force, and I'm wondering why I don't always do this intro. I'm crushing it right now.
You're pretty good.
All right. Nick Good. Here's the thing about multifamily investing. This is why you go multifamily. Nick is dealing with some single-family drama right now. Not family, single-family residential real estate drama right now. And he had to run to go put out a fire.
See what happens? He strayed off the path.
Mm-hmm. We are super excited to have Brian Gramlich on today with Terrydale Capital.
Welcome, Brian.
Yeah.
Thank you guys. Nice to be here.
We're going to be talking about some awesome stuff, but first we got to do our intro, so we're going to get started right now. Welcome to More Doors Podcast, brought to you by Deep Blue Capital. If you want to check out our company, grow with us. If you'd like to expand your multifamily presence, if you want to get into passive investing and learn how you can build wealth while making a difference, go to deepbluere.com. Join our investor portal or our newsletter. You'll get all sorts of insights into what we're doing right now, what's going on in the market, upcoming projects, webinars, events, things like that. So go check out deepbluere.com and make sure that you give a little love to Tor Studios. That's the studio that I am sitting in right now. And Mr. Jesse on the other side, he produces all kinds of shows, including this podcast, others, and he is a total bad ass. And we always like to show him some love. So go check out Tor Studios. We will have I'm just going to commit to it. We're going to have the episode or the website live by the time this episode airs. Go check out torstudios.com. That is a manifesting your vision right there.
It'll be there.
It'll be there. We hadn't finished it yet, but we will. torstudios.com. Whew. All right. I'm done with my part.
How much coffee have you had today?
Believe it or not, this is my first.
Why so small, dude?
I know. Well,
come on.
That Keurig.
Those are rookie numbers.
I hit 10 ounces on the Keurig, and that is
so did I.
10 ounces came out.
Yeah, I don't think so.
I got about
There's
5
a little
ounces.
light.
Exactly.
Evaporation happened.
Oh, man. Let's dive
By the way, also go follow us on LinkedIn, Facebook, and Instagram.
Yes. Instagram
Excellent.
now is up too. There's just nothing on it yet, but there will be.
Because we have a beautiful video of our mural.
Yes, we do.
We have to put it up there. And some pictures of before and after of the rehab project.
Take a note of that. I'll put that
yes.
down. All right.
We're trying to keep you off the selfies.
I'll do that today before golf. All right. Let's dive in. Brian, welcome, brother.
Thank you for having me.
Absolutely. It's good to see you in studio. We always like to have the guests in studio when we can. It's way more intimate.
Absolutely.
Love it, man. What's going on in your world right now? We got a ton of questions to dive into. We always like to start at the outset. You have a totally different maybe perspective on the market than we do, just because you're on the financing side. We're more on the deal flow and cap raising side and syndication side. June 8th, 2023. Perspective on market, where we've been, where we're going. What are your big ahas in the market right now, or your key takeaways, or just things you're thinking about?
Hold on 1 second.
Whoa.
Tell everybody where you're from.
Sorry.
We got to do that.
I'm not the normal host.
Yes, I understand. This is what happens when Nick has single-family drama.
Well, I'm from Dallas, Texas, headquartered in Dallas, Texas. We also have an office in Kansas City, and we focus on multifamily financing and industrial financing nationwide.
Love it. Love it. And by the way, for those listening, we didn't just pull Brian off the street. We've had an existing relationship with Terrydale for several years now. We've done both. We've done bridge financing. We've done bank financing. We've done refinances with Terrydale Capital. And quite frankly, they've been our go-to financing partner on a number of different projects now for several years. So if you're not familiar with them, get familiar with them. Brian's got a great team, and we brought him here today just because he and his team have been absolutely phenomenal to work with, and they're really on the cutting edge of the market. So I just wanted to throw that out there to you.
I appreciate it, and appreciate all the work that we've put together, and you guys have been great partners.
Awesome.
If you don't know, now you know.
Wow.
So key takeaways. Right now in this market, I think we're seeing a lot of investors start to adjust and get more adept to what's going on with regards to the rate change. I think for the last 6 to 12 months almost, you've had a lot of investors not know what to do. And so usually when that happens, you have people to take a step back. I'm going to hold off. I'm going to stop, set, and reset.
Yeah.
I think what we're seeing right now in real time is a lot of investors, especially ones with existing assets that have floating rates, that have maturities coming up in the next 6 to 12 months, they're getting off the sidelines. So in the last about 3 to 4 weeks, we've seen a major pickup in investors looking to get some stable conventional financing and set the new rate up, because as you're watching in real time as well with what's going on with the U.S. Treasury Department, the Fed, we don't anticipate rates to really take a big step back anytime soon. And I think right now it's time to get whatever you need done so you can be stable and ready to take advantage of the market as we go forward.
Love it. So just for those that don't know, Brian, give us a little background on Terrydale Capital. So I know you talked about the verticals that you support before, but what's Terrydale Capital's go-to-market?
Sure. Terrydale Capital, we focus on finance. So we help investors structure finance through all the capital markets. And we work with agency lenders. We work with commercial banks from the small regionals all the way up to the nationals. We work with life insurance companies. We work with CMBS. We really look to understand a customer's needs. So if you're doing a $1 million loan and it's a short-term finance, it's a lot different deal than a $40 million development project. You're going to need a totally different type of capital structure, and understanding exits and those types of business models really helps us structure finance to optimize returns for your investors and the investors themselves.
Gotcha. So you're not a direct lender?
I'm not a direct lender.
Okay, so you're a broker.
Yeah, we're a broker, we're an intermediary, and a correspondent.
Got it.
And that was, I think that you kind of almost answered this, but I'd love you to elaborate, right? And, we just talked about the kind of subtle difference between lender and broker, right? In the multi-financing or the multifamily game, especially, where financing is so key. In the single-family game, you go hard money and it doesn't work out and you refinance, maybe you lose a few bucks, right? And you should have gone on just a conventional and put 20% down. It's really not the end of the world. Financing can fundamentally make or break a deal worth millions of dollars in the multifamily game. Why is it so important to work with a broker as an investor for your financing rather than just going one route, one product line, like that's it?
Great question. Lot of different ways to answer that. One way I could answer that is just we've had clients that come to us after they've sought out financing for themselves. They worked with a bank. That bank told them, because they're working with maybe a young loan officer, said, hey, we can do this, X, Y, and Z, and you get 45 days into the process and they're not able to execute. Firms like ours, specifically Terrydale, we want to vet the lenders. We want to understand how their credit committees work. We want to understand what their debt to loan ratio is, debt to liquidity ratio is, especially with these banks and what's going on in the volatility in the market. If you're working with local and regional banks, you need to have a lot more due diligence about what's going on and who's signing off on these deals. If they have high exposures to certain asset classes, you could run into a situation that in 60 days that they've lost their appetite for that asset class and you're left holding the bag. So groups like ours, we don't get paid unless the deal closes. And so we're not going to want to work on a project that we think is a low probability deal. We're not going to want to work on a project where you have a high chance that deal may fall out because the lender is on shaky ground. So we want to work with quality people, and that helps align investors with brokers like ourselves to make sure you have proper execution and streamlined processes. One other thing that I think is really beneficial, especially in this market, is there's a lot of investors that haven't done as many deals as maybe someone that's been in the market for 40 years. And so there's a lot of trips and falls that investors can run into when you're not working with someone that's done 100, 1,000 transactions, seen issues come up, make sure insurance surveys, floodplain questions, environmental questions aren't addressed up front. borrower experience, liquidity, net worth, all those things are hammered on the front end, especially with a broker that's going to put a second set of eyes on it to help streamline the process.
Yeah.
Would it be safe to say, because that's a phenomenal explanation, and I appreciate it, would it be safe to say, if you're not working with a broker, you better be pretty confident in being your own broker?
Yeah.
Right.
No, we are a technology company, Terrydale is. We have our own proprietary CRM. We have our own proprietary, a lot of internal technology. And one of the things that I've been tracking is, what does it really take to close a deal?
Right.
What's the timeline? How much correspondence, how much communication is it really required? The numbers aren't perfect because every deal's different. But I would tell you that what I'm looking at is somewhere in the neighborhood of 40 hours just internally during the closing process that my staff are working to close a deal.
Mm.
And that's a smooth deal.
Mm-hmm.
Usually we're looking at anywhere between a little over 350 to 400, 500 emails.
Wow.
So what we're going to be what I would tell anyone out there is, if you have another job and you're trying to do this on the side, that's great, but you're going to take on a full-time job during this closing process.
Do you count resending emails to people like Nick who missed them the first time?
I think it all gets captured.
Nice. Yeah, I think that's a really good point, Brian, right? And so I think there's an efficiency thing, right? An efficiency play in working with a company like Terrydale or a broker. But what I also really appreciate about what I think you guys do really well is how you size a deal up early on between financials and the story and the background and timeline. Because I think when all of us probably first started, right, and we'd raised our hand and called the bank, we didn't have everything that we needed,
Sure.
right? And then you might wear out that loan officer before the deal even gets fully packaged, right? And they're just tired of dealing with you because you didn't give them a full package up front. What I really like about you guys is we can shop a deal or have you preview a deal, and you give us kind of a punch list of things that you're going to need. We come back to you with it, and now you're equipped to go figure out which bank's buy box this deal fits in, and who can you call, and who can you preview that deal with before we get too far down the wrong road. And there's just a huge upside, in my opinion, to having a resource like that.
Oh, I appreciate that, and I do think and I believe that we are, experts in these markets, in these small markets that we really hone in on. And I think the advantage of having someone like us that are underwriting thousands of transactions a year, we really understand, hey, this is where the market's trending. Here's rental rates. Here's, I can tell you if it's a certain vintage multifamily deal in a certain, major market, if the expenses per door per year are too high or too low, I can quickly say, okay, they're either not spending enough, the sales broker is given maybe a too aggressive a pro forma, and those can help save a lot of time and energy if you start chasing something down, thinking that, hey, wow, that cash on cash looks amazing, that pro forma looks like we're going to outperform what our investors are looking for, but oh yeah, they quoted insurance at half the price and they didn't bump up taxes, and there's also no payroll expense.
That doesn't happen.
No
Stop it.
way.
Those are some of the things that I think are helpful, so I appreciate you saying that. And I think the other thing that helps is just being able to poke holes in someone's package. So if someone comes to me and says, hey, I got this deal, and we go through those same questions, very quickly we can say, well, look, here's a couple issues that every lender is going to look at. We need to mitigate this. Yeah. And if we can mitigate those on the front end, it'll streamline approvals, it'll streamline response times. It may save that extra 10 days that makes the difference in the deal.
Sure. Awesome.
100%. I mean, we experienced that, I think, in our last deal with Terrydale. Got a lot of advisement on what what the lender was going to be looking for in our package, and we were able to make some adjustments there and get the deal done. So
yeah,
it was wildly beneficial.
Absolutely.
You mentioned just a moment ago, just the repetitions, thousands of transactions a year, having a real pulse in the market. When you talk about the capital markets today, everything from banks' appetites for deals to different structures they might be looking at, and maybe reserve requirements, things like that, rates, obviously. What are you seeing in the capital markets right now that might be very unique to this particular moment in time?
not sure about unique because I just feel like everything kind of history repeats itself. With rates, for instance, I think, like I mentioned earlier, that we're starting to see people get accustomed to 5, 6, 7% rates, and when that happens, and I've been in real estate since 2005, gone through the downturn. It usually takes a market roughly 6 months to adjust to a big change, and once that happens, the smart people start making transactions happen. And I think what we're seeing is sellers come up and start to understand, hey, this is the new reality. The ones that need to make a deal happen, and so I think we're going to see a lot more transactions in Q3, Q4 in today's market. Don't know if I answered what you're asking.
You hit the nail on the head, honestly, because we talk about this internally a lot. And we even talk about this in our residential sales teams, right? There's really just no such thing as a bad market. There are just different variables. And then on a certain whatever time horizon, you're just going to get accustomed to those variables. And so, 6 months ago, the notion that Fed's going to raise rates again, the world is falling down. How could you do any deals at 8%, 9%, 10% interest rates? Well, the reality is asset prices would have to come in line with that, right? Like, you just need to account for the variables. 8%, 9%, 10%, whatever interest rate you get, that in and of itself doesn't make or break a deal. What you just have to account for is the seller expectation that the asset price is still going to be where it was when rates were 3%, right? And those things just take time. So there's no such thing as a bad market. There's just a time horizon for sellers and buyers to get back in line. I think we're starting to see that happen now.
To hit that, back I think it was 16, maybe 17. I went out and bought a small apartment complex. Interest rates back then were like 4.25%, 4.5%. I did like a 14% interest only loan, hard money loan. The cap rate going in was probably 3%, but I tripled my money. Because you can't always look at those metrics. The rents on a 800 square foot unit were only $400. In that submarket, I already had financed property in that submarket and knew that you could get $1,200 with some updates. So the cap rate looked like crap going in. The interest rate looked like crap starting it, but it doesn't really matter when there's a lot of juice and you need to act quickly because you want to beat everyone else to the punch. So, sometimes you have to look through just what the rate is, what the cap is, and really understand what the market is and what that opportunity is.
I think that's kind of what investing is all about, is identifying opportunities, right? And if you're just going to take it at surface level and say these are the only numbers that matter, you're going to miss out on a hell of a lot of opportunity throughout your career.
Agreed. The other thing too that, and I was just thinking about this, is I think I've just seen a little activity pop up in just the last week or two, right? How many deals did we get this week?
Right, a dozen already this week.
I think in Q4 of last year, and let's just call it the first half of this year, we not only had the uncertainty over rates, but at least in Texas, right, where we invest, you had property taxes get completely maxed out, and in many cases, right, completely overassessed. And insurance has gone through the roof. I have never underwritten. I underwrote a deal the other day at $1,800 a door for insurance. Right? Not even in a flood zone. So you got rates that went from very quickly from high 2s and low 3s up to 6 and 7, and then you have insurance going up 40, 50, 60, 70% in some cases, and property taxes get completely maxed out. Everybody has to take a step back and say, okay, on top of rent growth plateauing, right? And others
even shrinking a little.
Exactly. Everybody just had to take a step back and say, what is going on here? These are my 3, 4, 5 key underwriting criteria, and they've all changed, right? And how do we recalibrate our expectations and our expected returns to our investors and our buy box and the type of properties we're looking for, et cetera?
100%.
No, I think you said it perfectly. You can't just play in the same. You can't play the same playbook when the market changes. No. You have to adjust the playbook. You have to look at, does this thing make sense anymore, and make those adjustments.
So, no, go ahead.
No, I was going to say, you talked about Lifeco and CMBS before, and we'd love to get your thoughts on regional and bridge funds and agency debt, but I haven't heard anything really about Lifeco and CMBS lately. So
Sure.
when you think about funding sources like that, how are they doing in this market?
Well, CMBS is dormant.
Is it?
Yeah. So I think, I just got off the phone with a friend of mine who runs a CMBS shop, and there's not much going on.
Why?
It's not a very competitive market. The B-piece buyers are not very active right now, and I think it's just tough to securitize these loans. That always changes. And when it's feast or famine, and when their rates or spreads get inside of what we're going to see with banks or regionals, because they can do a 30-year AM, they can get a little more aggressive on leverage, they can come up with creative solutions that may not be something a bank would do or the agencies would do. Maybe there's a net worth of a client on a larger deal that doesn't meet a 1-to-1 ratio, and they can price adjust to make that deal work. So in their non-recourse loans. So, when investors need to hit certain categories, sometimes that road leads to CMBS. But right now, you're just not seeing a lot of activity there.
Interesting.
Life insurance companies are active, but there's just not as much deal flow, and they already are a smart slice of the pie from a lender execution. And typically, this isn't always the case, but typically most life insurance companies fall into a higher loan category. So, 10 million plus, lower leverage, more risk-adverse assets. So you're going to not necessarily see them out on the street every day. You're going to see them on, larger portfolio opportunities. Some, maybe REITs and some other firms would use them to structure deals that are a little more specific to the guidelines of the investor portfolio. So, they can do a 20-year fix with a 20-year amortization or something along those lines. But their rates are always inside of most traditional conventional options.
Got it. Cool. So walk us through what you're seeing with regionals. I think the latest deal we did with TDC went to a regional. They put a fantastic deal together for us, and they've been frankly a pleasure to work with since then. But what are you seeing from your other regional partners?
Well, I'm glad to hear that. We're seeing a little bit of everything. We had a major national firm just say we're pulling out of the real estate altogether. They're pulling their real estate arm off.
Wow.
That's an extreme example, but that was news as of this week. I think, generally speaking, every regional bank that has a tighter deposit ratio is being extremely conservative, really only working with existing clients. And then there's a lot that we're looking through and looking for that have a abnormally high depository accounts, and they're ready to lend.
Really?
And so we have a number of those that we're leveraging and using in the marketplace right now to get deals done. But it just takes a little bit more time. I mean, the average amount of quotes we get per transaction has tripled.
Really?
So, if we're looking at a deal and we're trying to get a quote for you, and it usually we usually could identify, hey, that market, that asset class, that loan size is going to fit, hey, this box of our top 5 opportunities. Now that's great. Those top 5 we're going to reach out to, but we probably should reach out to about 20.
Yeah. No kidding.
Yeah.
Wow.
So, an extreme example, some of the deals that we're doing in, we're looking at some deals in Georgia and the Carolinas, and in those markets, we've gone up to 70 lenders. Wow. So, yeah, we got to look through a lot, or, turn over a lot more rocks. And I think that also says, I mean, if you're an investor looking for a loan in those markets, do you want to go to 70 lenders?
Yeah, no. You can't.
You can't.
How do you do
you'll
that?
Never get the deal done.
You'll never close. Exactly.
So yeah, I think, but in some of those instances, it's also just understanding the full scope of where the market really is. Because when you've had a change like this and you think, hey, this is where the market is, well, once you reach out to 70 lenders, you should have a pretty damn good idea where that market is.
Yep. Agreed.
100%. I mean, and that talks, I think, a little bit. We spoke before. This was kind of our list to talk about. Is overall buyer sentiment and things like that. I mean, a lot more optimistic now, it feels like, than several months ago. And it sounds like, I think that buyer sentiment really is a reflection of the financing sentiment. When you've got 70 lenders bidding on, looking to finance a deal, people are looking to place capital again, which it really feels like.
Yeah. And then let me be clear. Those 70 lenders weren't all ready to lend on that.
Sure.
It was, there was only a few, so we had to reach out to more and more.
Right, I see what you're saying.
But I do agree that we're starting to see a lot of investors that have been on the sit and wait camp move into, let's start looking at stuff and let's see where we can make some money.
Nice.
100%.
Nice. What about bridge funds?
That's what I was going to ask.
Yeah. So personal example, we did 2 bridge deals at the end of 2021.
Yep.
Great lender, right? They bundled in most of our CapEx into the deal. These were heavier lifts. But what are you seeing from those players right now?
Still active.
Really?
Yeah. We're still seeing a lot of activity with the bridge lenders. There's on the spectrum, you got some that have entered the market that are coming in a little more aggressive, and then on the other end, you got some that have, got out most of the capital and they're going to sit and wait for a while.
Mm-hmm.
But for the most part, they're our most active space. So we're still doing a ton of lending through those types of resources that are a little more flexible and a little easier to get deals done through those resources right now, because banks still have a level of volatility to get through those approvals. And when and have the assurance of closings, because it's a private capital group, they're not audited and dealing with the FDIC and so on and so forth. It's just a better execution when timing's of the essence.
Yeah, love it. So I think you mentioned before rates in the 5, 6, and 7s, right? And I think you were probably referring to agency and kind of traditional bank financing. What are you seeing from an interest rate perspective with the bridge partners lately?
A wide range.
Yeah.
On the low end and the 7s, on the high end, 10s.
That's not bad.
Yeah.
Okay. Nice.
So going forward, when we talk about, we just talked about bridge funds a second ago. We've talked, and even Matt's talked quite a bit on the show. Theorized about the amount of bridge debt coming due this year and next year with really no exit plan or opportunity.
Yep.
Do you see that on the horizon, and how do you think that plays out?
Yeah, we're seeing it in real time for sure.
Yeah.
There's a lot of executions that happened, in 2021. 3 to 5 year bridge floating rate debt. I mean, the most sophisticated firms out there weren't banking on this type of increase. So there's a lot of, big dollar loans out there that are on floaters that didn't even have rate caps back in early 21. Yeah. So I think you're going to, and some of that's not reported because their maturities truly aren't coming maybe in the next 12 months or maybe even the next 24 months because they were 5-year deals. Yeah. But if they're a floater without a rate cap, that's essentially a maturity this year.
In and of itself, yeah.
Yeah, I mean you can't sustain it if you underwrote the deal at 3% and it's at 11 or 12 now.
And your insurance increased by 50%, and your property taxes went up, and your rents might not be growing at the same rate as you expected. Yeah, it's a perfect storm.
Yeah, I would say that the investors and clients that we're speaking to that have stuff out there, I haven't heard, we're in trouble as much as we need to reestablish a better loan. Mm-hmm. And so we're doing a lot of getting out of those floaters and moving them to just more conventional and agency type deals. Mm-hmm. Yeah, they're not getting that underwritten 4% stable loan, but they're in the 6s or high 5s, and it's getting the deal done.
Mm-hmm.
So you believe that there's an opportunity to absorb that bridge debt into, is there a big enough appetite to be able to absorb the bridge debt to move all of them into different products, the amount that is coming due, or would you run out of space eventually?
I don't know if I'm sophisticated enough to have the macro data to do that, but from what I see just on the front lines, it feels like there's going to be enough.
Yeah.
What you hear and what I've read is a lot of focus on office, big office buildings, and it really dilutes the real story of where the market's on the multifamily and where most of the transactions happen in commercial real estate.
Yeah, office has got its own problems.
Yeah, but frankly, I've never. I mean, the office deals that we've done, and I've closed a number of them. In my 15 years of doing this, I've never closed an office deal at 85% leverage.
Right.
It's usually 60-65%. Even in 2014, 15, and you had 100% occupancy deals. Yeah. So I think if you have, a really big slide in occupancy in those deals, I know we don't want to talk about office, but I do think everyone's talking about it out that doesn't do commercial. And they say, "Oh, commercial, that must be terrible." And I'm like, well, for someone that over leveraged office, which was really tough to do, maybe, but I think it's less than 1% of the market.
Yeah, it wasn't very standard.
Yeah,
that makes perfect sense. Mm-hmm. Yeah, I think that's the doom and gloom scenario people are trying to understand right now. Is there a bridge debt time bomb? It feels like you're saying maybe there's enough to ease the pressure that the bottleneck starts to release itself.
There's gonna be stories of people that get hung up.
Yeah.
And it's gonna happen. Is it gonna be as crazy as I think some of the private equity groups want to see? I don't think so. I think you're going to see a number of them happen. There's going to be those outliers, but I think there's going to be a lot of people that just need to get out where they don't want to, they may get squeezed enough, they're not getting enough return, they move into something else, and they're going to give some opportunities away.
Yeah.
And that's where you want to stick. That's going to be a bigger chunk of opportunity when you can find the right finance structure, right capital partners, and right market to focus in.
I think the big thing too is there are some people that I talk to that are comparing what we're going through right now to 2008, 2011, and I think the big difference is there's a lot of cash on the sidelines right now. Right, back then there was no money. Right, banks were failing. Left and big ones were failing. Right, not the small, relatively smaller ones of this year. That there's a lot of money on the sidelines. And I think as these opportunities pop up, right, you'll have plenty of investors that are smart, like us, perhaps not as handsome, that are ready to jump on opportunities, And at the same time, I think there are going to be syndicators and GPs that took down deals in the course of the last 2 or 3 years that maybe those deals aren't going to perform as they were underwritten, and they're just going to get out. And they're going to say to their investors, guys, this one was a miss. We're going to get out. Bad news, we didn't hit our targets. Good news, you're not going to lose anything, right? We just need to get out, right? And there's going to be buyers for those deals, right? If they can't get new financing, I'm convinced of that.
100%. And I think in addition to that, what I love about real estate, I've been in it a long time. Grandfather was in it. Dad was in it. One thing that I was always taught was, look, you can be an idiot at buying something as long as you hold on to it long enough. The value will be there.
Yeah.
And so, I think there's going to be some investors that are going to take that road and say, look, we're not getting where we want right now. Let's weather the storm and get some stable financing for the next 3 to 5 years and then see where we're at.
Yep.
And I think, generally speaking, you're going to see some appreciation.
Yep.
Yeah. And so the appreciation, kind of leads us to our next question. Right now, on the deals that you are seeing, are you seeing deals, either refis or acquisitions, that are being affected by appraisals?
Yeah. Yeah, we are seeing appraisals slowly come down.
Yeah.
Mm-hmm.
So, on average, where we saw value in 2022, those, and I'm making up this number, but it feels like anywhere between 5 and 10% under where those 2022 values are, and we could see a little bit more as these things level out.
Mm-hmm.
And we were getting super aggressive values for the last 5 years, so I think you are going to see that delta happen for a little while.
Now, what do you attribute that to, though? Is it cap rate decompression, so that the appraisers are using a slightly more conservative cap rate when they're running the value, or is it more performance related? Where is it coming from?
You actually hit the you actually hit it just a little bit ago. It's the taxes, the insurance, the cost of keeping people in front of these, like, an office manager costs more today. So you got payroll expenses that are a little higher, and all those expenses that have inflated, and then you're also seeing kind of the plateau of those rent bumps. So I that's a big part of it. So you're just not getting as high a NOI as you were before.
Got it. Business. One of the variables has got to give. Yeah.
I also think that I think the way at which multifamily accelerated coming out of 2020 into 2021 is coming back to bite us in the butt a little bit, right? So here's what I'm specifically talking about. I was bombarded with deals to take a look at that were being priced assuming 80% LTC financing through a bridge fund, right? The agencies were doing 70, 75, maybe 65 in some circumstances. But brokers knew, multifamily brokers knew that bridge financing was out there and it was likely easier to get than agency financing. So they were asking larger price tags for these assets because it was easier for the investor to step in, get 80% leverage, including CapEx from a bridge fund, and overinflating the price of those assets.
Yeah, they want it done quick with a lot of hard
money. Yeah, exactly.
And so the quicker you have to go through the underwriting process, the faster you have to, and the more money you have to put up. It's a recipe for things to be missed.
Yeah, I mean, it's amazing. It's amazing how things have changed. Where, I'll say 2 years ago, just using round numbers, we were getting finance proposals in an OM that included an 80% LTE bridge fund debt, right? And now everything that we're seeing, pretty much everything that we're seeing, is assumable agency at 3 and change, right? I just think some of that overinflated price because of those types of financing options that were out there, right? And inflation on the prices as a result is kind of coming back to bite us a little bit.
The history repeating itself. You look at what happened in 07, 08. I mean, again, we're not in the same. This isn't the same category. However, 100% financing back then. Yeah, you could get 110% financing in some cases. Right. So, I think you're right, Matt. And back in, to even go back further, when I was thinking, and I was wrong, but I was thinking that the market was going to have a pullback or kind of a setback, was I think 16 or 17, and around that time frame, all the brokers that were bringing me deals that we were underwriting, looking at deals, like, we need IO. It's agency, but we need IO. Yep. And I'm like, if you need IO to make a deal work, it's too high. Yeah. And sure as shit, about 2 years later, it wasn't even the IOs didn't work. Don't worry about the IO because we're at only 65. We got to make it 80% with 3 years IO. Yeah. And we'll figure it out when the rents catch up. Yep. I'm like, all right, well,
definitely a warning sign.
Yeah.
Right? It's kind of the same, I thought when you were just talking about a couple of years ago, and 80% and a lot of bridge financing. Were you seeing that even in OMs on deals that didn't have like extraordinary CapEx?
Oh yeah, dude.
And that should be such an early warning sign.
I saw 80% LTC financing being offered on stabilized properties, not necessarily on the A stuff where it was easier to get agency, but you took any sort of value add, right, was just, it was assumed it was going bridge. And I was looking at certain deals that were just, 110, 125 a door back then, right? That just didn't make sense on paper, They were just, they were betting on the financing and significant cap rate compression and rents continuing to explode as they were during the latter part of COVID, and that stuff has just not happened.
Yeah,
right.
100%. Thoughts on second half of the year? We're almost done with Q2. Wow, this year's flying by. As we sort of wrap things up, what do you think? Outlook on the capital markets for the second half into 2024. What do you guys? I know you guys do a lot of analytics. What do you sort of see on the horizon?
What I'm seeing is people's really getting interested to look at deals. So I think maybe people are just bored and want to get back into it.
Well, there's more deals to look at now is the good thing.
So we're seeing double the amount of opportunities on a weekly basis
Nice.
starting to hit the market, and people kicking the tires on refinances a lot more. So I think, like I mentioned before, I think right now, I feel like people starting to understand where this market is and and they feel like there's a little bit of a guidance of what to expect in the next 2 quarters, which wasn't there, 3 months ago.
What do you think happens if you had a crystal ball, Brian? What do you think happens in 24 with rates?
I've been wrong every time that someone's asked me about rates.
So then tell us the opposite answer that you were about to.
So what I would anticipate going into an election year is to try to take, any disruption with the Fed out of the discussion points. So you would think that they would, either settle down or at least maintain. So I don't think we're going to see rates go back down for a while. But we may see them at least stabilize and maybe just fall in the Treasury range of 3.75 to 4% on the 10-year. And hopefully we actually see a normalized yield curve. And if we can get to that, then I think that's a positive outlook going into 24, 25.
Love it. Love it.
That is one of the we just kind of stopped talking about that. Like, we've just gotten used to yield curve inversion. Like, nobody's even talking about the 2-year right now.
No.
It's crazy.
No, it's something that's kind of interesting that people are just used to it being inverted, and I think it looks like it's getting a little more normalized, but that would be a good sign if we could see that by Q4.
Agreed.
Nice.
Agreed 100%. Brian, we super appreciate start over. We'll edit that out. No, we won't. We just roll with it.
I'll just leave it.
We really appreciate having you on, man. How can people get in touch with you and in touch with Terrydale?
Go to our website, terrydalecapital.com. You can reach me really by all means. We're on LinkedIn. We're on Facebook. We're on Twitter.
Love it. Man. Cool. Brian, man, thanks so much for your time. This was awesome. Appreciate everything that you and your team does for us and plenty of other investors out there. You guys are honestly one of our best business partners, and we just know that when we come to you with something that we're going to get the skinny and we're going to get really solid help. So appreciate all your insights today.
Likewise. Thank you, guys.
Cool.
Absolutely.
Thank you.
Appreciate it, guys. Check out more episodes of the More Door Podcast. Go to deepbluere.com, and we will see you on the next episode. Thanks, guys.
Follow us on socials,
Follow us
LinkedIn,
on social.
Facebook, Instagram.
I know. I'm sorry.
That's
Nick,
okay.
Nick will be back for the next episode. He does
That's
all the
right. You
work
did a good
there.
job.
I appreciate it.
And you wore blue today, so that's a big. I tried too.
There we go.
Nice.
Thank you, boys.
Thank you.